Stocks tumbled on Wall Street on Friday as investors reacted to news of the biggest U.S. bank failure in nearly 15 years, and concerns about rising interest rates. The S&P 500 fell 1.4%, marking its worst week since September. The Dow Jones Industrial Average dropped 345 points, or 1.1%, while the Nasdaq Composite sank 1.8%. Some of the sharpest drops came from the financial industry, with banking stocks hit particularly hard. Regulators took over Silicon Valley Bank in a surprise midday move after shares of its parent company, SVB Financial, plummeted more than 60% this week. The company, which served the startup industry, was trying to raise cash to relieve a crunch. Analysts have said it was in a relatively unique situation, but it has led to concerns a broader banking crisis could erupt. The market's response came amid what strategists in a BofA global research report called the crashy vibes of March. Markets have been nervous about high inflation, which could force the Federal Reserve to re-accelerate its hikes to interest rates. The yield on the 10-year Treasury fell sharply from 3.91% to 3.69%, helping to set rates for mortgages and other important loans. Some of the sharpest drops on Wall Street came from banking stocks, with worries about who else may suffer a cash crunch if interest rates stay higher for longer and customers pull out deposits. This could force banks to sell bonds to raise cash, right as higher interest rates knock down prices for those bonds. Besides SVB Financial's struggles, Silvergate Capital said this week it's voluntarily shutting down its bank. It served the crypto industry and had warned it could end up less than well capitalized. Stock losses were heaviest at regional banks. First Republic Bank tumbled 14.8%, but filed a statement with regulators to reiterate its strong capital and liquidity positions. Charles Schwab lost another 11.7% after dropping 12.8% on Thursday, as investors stretched for read-throughs from the SVB crisis, according to analysts at UBS. The analysts called them logical but superficial because of differences in how companies get their deposits. Larger banks, which have been stress-tested by regulators following the 2008 financial crisis, held up better. JP Chase rose 2.5%. All told, the S&P 500 fell 56.73 points to 3,861.59. The Dow lost 345.22 to 31,909.64, and the Nasdaq dropped 199.47 to 11,138.89. Investors are closely watching the situation to see how it develops in the coming weeks. Some experts believe that the market is simply going through a correction, with stocks having been overvalued for some time. Others worry that the problems in the financial industry could lead to a broader economic downturn. It's important to remember that the stock market is inherently unpredictable and subject to fluctuations based on a wide range of factors. While Friday's tumble was significant, it's important not to overreact or make hasty decisions based on short-term market movements. Instead, investors should take a long-term approach to investing and focus on building a diversified portfolio that can weather market volatility. In conclusion, the recent stock market tumble on Wall Street has been driven by concerns about rising interest rates and the fallout from the biggest U.S. bank failure in nearly 15 years. While the market's response has been significant, it's important to remain calm and focused on long-term investment strategies. As always, investing carries risk, and it's important to consult with a financial advisor before making any major investment decisions.